This is 8-Minute Market Structure by Texture Capital, bringing you concise, expert insight for better markets. And now your host, Richard Johnson.
Hello and welcome to the latest episode of 8-Minute Market Structure, where I speak with industry experts and get their take on the most important market structure issues. It's a simple format, the same question for every guest. If you're building a new market structure from scratch and could change one thing, what would it be? It's one topic, no prep calls, just 8 minutes of concise, expert insight for better markets. My name is Richard Johnson, and I'm the CEO and founder of Texture Capital. We're a FINRA member and SEC-registered broker-dealer specializing in digital securities. We help our clients more efficiently participate in private markets by providing tools for issuance, tokenization, and secondary market liquidity. Today's guest is Dave Weisberger, who is the co-founder and CEO of Coinroutes. Coinroutes provides algorithmic trading tools for buying and selling crypto assets more efficiently, consolidating data from over 40 exchanges across over 250 pairs to empower smart routing and trading algorithms. Prior to Coinroutes, Dave had a long career on Wall Street, including stints at Citigroup, Lava Trading, and Two Sigma, focused on electronic trading and market making. And I am particularly excited to have Dave on the show, as he's a fellow Wall Street veteran who's made the move to digital assets. And I'm very interested to hear what you want to talk about. So let's get right into it, Dave. If you were building a new market structure from scratch and could change one thing, what would it be?
Well, it's kind of a wide thing. I would want a market structure that evolved without regulations that forced market structure in a particular direction. So when looking at crypto, which is what I've been doing for the last 5 years, we have a market structure that evolved out of what people term the Wild West. But the truth of the matter is, without regulated tick sizes, without daily settlement cycles that are based on old technology and old regulation, without regulations that stop people from trading the same asset against multiple currencies in the same exchange, without regulations that enforce risk management, where crypto exchanges had to create real-time liquidation and real-time funding currencies on the derivative side, you end up with a market structure that is clearly evolving to be a better mousetrap than what we see in the equity world. And while that sounds like an outrageous statement, given the supposed issues of volatility in crypto, it really isn't. And I'll give two examples, because I think that people who talk about volatility in crypto as being terrible are literally sticking their heads right where the sun doesn't shine in terms of comparing to equities. We'll compare Robinhood earlier this year, when there was good news on Robinhood and it opened up 80%, that's 80 for those counting at home, had multiple trading halts throughout the day and traded very liquidly with gaps basically for hours, that entire day before it stabilized. Bitcoin, on the other hand, people get the vapors when it dropped 20% last week, but it was incredibly orderly. There were $5 billion of futures contracts globally liquidated, but there was never a time when Bitcoin couldn't be bought or sold where price discovery was impaired. Give me a market without impaired price discovery over one where price discovery is halted due to volatility in the stock. Give me a market where we don't have these periods of time at the open where an entire 16 hours worth of news gets compressed into one tick, where only professionals could take advantage of retail any day. And so the notion of a 24-hour market without all of these extra constraints, to me, is definitely a step in the right direction. Now, does that mean we shouldn't have regulation? No, of course not. We don't want manipulation. We would like surveillance. We want people to have to say things that are true. We don't want wash trading. We want to have a clear picture. But once again, in the world of crypto, the other big difference between that and equities is that all the market data is freely accessible in full depth. At Coinroutes, for example, we process 15 terabytes of market data a day. And until very shortly, when we start processing CME market data, we won't have paid for a dime of it. Yes, we pay Amazon somewhere in the neighborhood of $90,000 a month to crunch all the data on behalf of our clients, but that's our internal processing cost. That's not paying for data. Now, yes, the exchanges have more profitable trading because margins are still higher, and who knows, maybe that will change in the future. But today, crypto is the most transparent marketplace in the world, because you have both all of the trading data freely accessible, and then you have the on-chain data, which tells you who's moving what, when, and where, which is significantly better. And it's something that obviously at Texture Capital, Richard, you're extremely aware of.
Yeah, I love that topic. I certainly agree with a lot of what you just said. I think I do think that using blockchain technology is a fundamentally better way to build markets. And that's what I said about to do with Texture Capital. We're focused on the private securities market. So it's not Bitcoin or Ethereum on the blockchain, it's private securities and maybe one day public securities. So I agree with that. I think someone else I heard describe, if you talk about DeFi and DeFi markets, it's kind of like, how that whole place evolved. It was basically engineers without a lot of experience necessarily in finance coming up with ways to do things without these preconceived mechanisms or rules. And there has been some tremendous innovation in that space. And I think we want to see a lot of that innovation. Look at how AMMs work compared to how traditional markets work.
Yeah, I think that's a really interesting topic. I was talking about it with an industry colleague yesterday. My opinion on DeFi is bifurcated. On the one hand, it will ultimately disrupt every financing activity that exists, whether that's stock loan, interest rate swaps, repos, all of it. So multi-trillions of dollars of markets. It will ultimately be a very interesting way and probably disrupt the way all dark pools and ATSs work, which have pricing that comes from external sources. However, the way it's currently working is not particularly good. The AMM process essentially means that whoever is biggest can effectively move the market. It is rife with manipulation. The word rug pulling I kind of find funny, or being rugged is something that can happen because of the way it works. And the reason that, however, the DeFi is so big has nothing to do with it being a superior market structure. It has everything to do with tax arbitrage. And that's a problem that needs to be solved, because the reality is whether you're the IRS or the Inland Revenue, you want to know if people are making capital gains, is it getting reported? Well, in DeFi, people are willing to take liquidity and knowingly pay 50 basis points more than they would net, than they would on CeFi exchanges, centralized exchanges like Coinbase, Kraken, whatever, or Binance. They're willing to do so. And by the way, that's an academic study that actually said it's 50 basis points on average more, but we at Coinroutes see that data. The truth is market makers are making that money. The DeFi protocols are making that money. And why is it? It's because nothing gets reported. And because there's no human beings to go to say, well, why aren't we reporting these transactions? There's nothing they can do about it. That is not a sustainable advantage. What is a sustainable advantage, however, is the ability to do peer-to-peer trading, and the ability to do so in an anonymized fashion with rules that are governed by smart contracts and governed by oracles that make sense. And so you see the push into oracles with Jump Trading's initiatives. I don't want to try to pronounce it, but
the Pith network, you mean?
Pith, yes, is it Pith or Pith? I didn't know, but okay. So the Pith network, you see the need for that. At Coinroutes, we basically aggregate lots and lots of data, as I said, 15 terabytes. All of that can govern the way people trade. So we're very hopeful that DeFi is going to grow, and we believe that Serum, for example, an order book-based DeFi is probably and DYDX is probably where the future is. That AMMs, when they become more dynamic, more reined in, where you can't where you can't necessarily move the price to almost infinitely, without people being able to react, is kind of a problem. I mean, think of it this way. The biggest issue with DeFi now in terms of arbitrage is understanding the gas fees and understanding paying higher. So they basically institutionalized something you and I used to deal with. When you were at Greenwich, you probably remember when people moved from ports in exchanges for high frequency traders, freely available, and the best firms getting the best ports the fastest to the market, to the exchange, and people paying for those best ports, to a world where all the port lengths, the distance from the matching engine, became the same and uniform. So right now, DeFi is the old days where you could effectively pay higher gas to get things done quicker. That's not a sustainable model.
That's a good analogy.
Like that. And so it's going to need to evolve, and it will evolve. I am hugely bullish on its evolution, but I would say appropriately skeptical of its current instantiation.
Yeah, well, I think I'm also very bullish on it, and I think there is a lot of tremendous innovation there. And there's a lot of inefficiencies and probably a lot of non-compliant activities, not just tax avoidance, but lack of KYC and all these other things. I got a little bit of time. I just want to come back to one thing you said earlier about the drop off in BTC in Bitcoin recently, in the crypto market in general, where it did kind of fall off a shelf by like 20%. I think that is kind of similar to some of the things we see in equity markets. when you talk about the flash crashes we have or in single stops. So I don't know if that's too different or too much better than what we have already. That still happens.
Look, there's more leverage in crypto than there is in most equity markets. That is true. And some of that is decreasing. I mean, for example, FTX quite famously got rid of their 100x and went down to only 20x. Makes it very similar to futures. I look at the most recent market action as extraordinarily constructive. Every time, basically this is the third time that you've seen one of these rallies, and every time you get a lot of speculative fervor, where you see funding rates going high, where you see significant long speculation, you see a sell-off. Every one of these sell-offs is getting progressively smaller and smaller. So the real question that you have to ask yourself is this a structural problem? And the answer is no. And riddle me this: what would be happening even with the NASDAQ futures if there wasn't an assumption of a Fed put? Mm-hmm. And there wasn't an assumption of the plunge protection team stepping in when there's a correction? We've seen plenty. 20% corrections are not that unusual, but when the government is buying securities, such as they are, whether it be corporate debt or equities in some countries, you have management of that. We don't have that necessarily, as far as I can tell, in the crypto world. So I'm not sure it's any different. And when you look at individual assets, you certainly have more volatility in individual assets in basically anything. Yes, there's even more volatility in some of the more obscure cryptos. That's true. But the reality is very large cap equities can have very large volatility. So volatility itself is an issue.
That's a good point. That's a good point, Dave. I'm not going to try and answer your riddle now because we are out of time on this, but I'd love to keep the conversation going on social media afterwards. And, I think it was a great discussion. Hopefully have you back on one time.
Thanks, Richard. Thanks for having me.
Thanks very much, Dave.
Take care.
This has been 8-Minute Market Structure. Be sure to follow Texture Capital on LinkedIn, where we will release a new episode every week. You can also find us on Twitter at texture_capital and on the web at texture.capital. The foregoing discussion is for information purposes only and does not constitute a solicitation to buy or sell securities. Private securities offerings are not registered with the SEC and are considered highly speculative. An investment in private securities may result in the loss of your entire capital contribution. Blockchain is a new technology and unproven in financial markets. There is no guarantee that tokenization will enable any secondary market liquidity in the future, and your investment may remain illiquid.